Hello, everyone, and welcome to our webinar. My name is Wassim Jomaa. I am the Chief Investment Officer of the Family Office, and I'm happy to host you into our joint webinar with our sister company, Petiole Asset Management, into this year webinar to discuss the outlook for 2025 and the asset allocation in this new era. In fact, it has been an eventful year, a year full of inflection points. The Fed cut interest rate. We had many geopolitical events. We had an impressive election that would have a lot of outcomes in the United States. And it's our habit in the family office and at Petiole Asset Management to be close to our investors and to our client and to our audience and to improve for them the situation in terms of clarity and information about the outlook and the potential risks that are ahead and how to allocate assets in a calculated manner. To this point, I am delighted and excited to have with me my friend Jeff Blazek, CFA, who is the Co-CIO of the multi-asset strategies at Neuberger Berman. As you are aware, Neuberger Berman, they were founded in 1939 in New York City with a global presence. They are our partner on the alternative side of the business. They manage around 500 billion in AUM across different strategies. Jeff, he's not only a friend, he's a mentor. He brings with him over 25 years of experience. In addition to being with Neuberger Berman, he spent some time at Cambridge Associates and before that at the Texas Teacher Retirement System. In addition to his current role, he is the co-chair of the Asset Allocation Committee, and he is the member of the Investment Committee and the co-chair of the Committee for Public-Private Investment and Neuberger Berman. Good morning, Jeff, and I hope that you are ready for this session because everybody wants to understand what's happening, going to happen in 2025, to understand the view, to understand the outlook. And let me start with some questions. What are the key themes that you see for 2025?
Great. Well, good afternoon to you, Wassim. Thank you for that kind introduction. And it's an honor to be with you in this audience today and look forward to the conversation. As you said, it was quite a complex year, a very good year, though, for a lot of markets. And I too am looking forward to diving in on this. What I'll do is I'll share my screen to set the stage for the outlook that as we look ahead to 2025, we have identified, as you mentioned, I am the co-chair of our Asset Allocation Committee, where we harness the expertise of our leaders at Neuberger Berman across all asset classes. And after a lot of debate and discussion, these are the 5 themes that we think will inform the backdrop of investments in 2025. So at a high level, there's 2 macroeconomic themes, which we've named Going for Goldilocks. The first being that we do expect yet another year of above-trend growth led by the U.S. We do think, however, the soft landing will broaden out to other groups. And then we have themes on equities, bonds, and alternatives that I know we'll go into more detail, but this is the overall landscape. We think that there's going to be a broadening of equities. There's going to be more focus on fiscal when it comes to bonds, and we do expect a major uptick in mergers and acquisitions.
Can you elaborate a little bit on your view on the economy? Where do you lean more? Is it toward a soft landing? Is it your base case? Or more into a bullish scenario where we can see a global recovery across the board?
Yes, absolutely. To provide more detail and to show you the evolution of GDP on the left side of this chart, we did have a bit of a scare in late 2022 when we were in the hiking cycle and there was fears of a hard landing. But then those estimates came right back up. We also had a very brief growth scare in the summer of 2024. But now we're on track for U.S. economic growth to be near 3% this year. Our projections are for next year, it will continue to be above 2%. And the rest of the world is benefiting as well. The U.S. tide is being lifted. It's lifting all boats around the world, in our view. On the right side of this chart, just to speak a bit to the inflation pressure point, we're showing you for major regions globally, the change in the core CPI, so normalizing a bit for energy and food prices, which had gotten quite uncomfortably high at almost 6% in the U.S. We've cut that in half. The Fed has achieved a lot of that deceleration in inflation. And those green hashes are showing you where were wages growing in each of these global regions. And at the time, wages were not keeping up a couple of years ago. Now, this is where we get into real income growth. The fact that consumers are benefiting from wages that are above prices, and we think that's going to be quite beneficial for both the middle income and lower income, as well as smaller companies.
That is very informative, but let me start something. During this year, we had a cut from the Fed, and that maybe played a major role. Do you think that into next year, we are going to have more stance from the fiscal side of the equation? And I didn't see that you have touched upon deregulation, merger and acquisitions into your outlook for 2025.
Yeah, let me cover the Fed first. And that to reiterate the theme, which is we were quite fixated on monetary policy. We were all Fed watchers. We've all been ECB and BOE watchers. And that was really important because the question was, after all of these increases that you see on the left side of the Fed funds target rate, where we got up to 5.5%, when will we reverse? And we did get that first 50 basis point cut in September. Unfortunately, when you look at those blue dots, that's where the market was suggesting the Fed was going to progress. And at Neuberger Berman, our fixed income group, we thought that was ambitious. We did not think the Fed was going to be able to cut rates below 3%. Our terminal rate expectation was more close to 4%. And indeed, as the economy has remained resilient in the US and around the world, the market has now priced, that red arrow is showing you that we are getting closer to a 4% terminal rate. We do view that as the appropriate neutral rate. It's not accommodative and it's not restrictive. Now, on the point about the fiscal, however, so bond investors, after we have one more cut of the Fed in December, we think there will be a pause. There may be one or two more cuts on the board. It's a similar discussion around the rest of the world. But the fiscal side is the problem. You can see that we are running a 6.1% budget deficit, highly unusual to be this high of a deficit in peacetime and not in a recession. And unfortunately, if action is not taken, you can see the trend will worsen where we're getting to almost 10% of a budget deficit relative to the size of the US GDP. And that's going to create a lot of challenges for bond investors and interest rates.
Okay. And what about your views regarding merger and acquisitions and deal recovery into 2025?
Yeah, this is to us one of the major benefits of the new administration is the fact that it's going to create animal spirits in the economy, lower regulation. There's a lot of pent-up demand for deals. And you can see here that mergers and acquisitions fell to a 20-year low this year. And we are already getting a lot of buzz from both the public companies and the private companies that we meet with that they are eager to begin to transact, whether it be via IPOs or corporate acquisitions. So we do think the art of the deal is going to be a major play in terms of, particularly with private investments, will benefit as more liquidity is executed.
Let me change the course a little bit. We were talking about the growth, about the fiscal side, the monetary side, but let's give some context because there are a few key questions that should be answered for the election result. We need, I guess, to get some clarity on the outcomes in order to understand the volatility in the market. Where do we stand? In which camp? Are we pro-growth or pro-inflation? Because now we see growth is doing well on that front. And what we are hearing on about the policies of this new administration and what we have been reading, that we have many imperatives that we need to focus on. Trade, immigration, tax, for example. What are your take on this basket?
Those are key questions. And although we are glad that there's no longer uncertainty with our election result, and we're going to have at least 2 years before another election in the United States, thankfully, because it took a lot of our attention and we're glad it's over. And the outcome was quite clear. The fact that Trump won a pretty decisive victory, as well as the fact that the Republicans have control of both the Senate and the House, allowed a quick collapse in volatility. There was tons of volatility going into the election, and we now have the VIX index at 13 and falling. So that's quite good for risk assets. You touched on some of those key drivers, the balance of growth, because I do think most investors understand the policies of the Trump administration are going to be pro-growth, but at what cost in terms of inflation? And the tariffs themselves will be inflationary. The key will be how much is executed relative to what he said during the campaign. Our estimates would be that if you take him literally, that he does an across-the-board global 10% tariff, if he does do a 30% China tariff, that could cause almost a 1 percentage point increase in the CPI, which would be a real problem, as we were talking about, with the Fed not able to cut rates more. We think it's going to settle in. There'll be negotiation. It'll be more targeted in certain countries and products. And our estimates at this point is for about a 0.3% increase in CPI in the U.S. next year. And our absent the tariffs, we thought inflation was going to go down to 2.5%. This means it's going to stay in the high twos. So I think that's going to be one of the key trade-offs to watch, is that balance of growth and inflation for the Trump administration.
And that would explain why you are saying that interest rate will stay elevated into next year, despite the potential drop or cut by the Federal Reserve. That maybe would put that into that context, if I'm not mistaken.
Yeah, Wassim, that's right. We think that the fair value of the 10-year Treasury is about 4.25%. We break that down into a real rate component, expected inflation, and a bit of a term premium. So we do think that right now interest rates are going to stay at these elevated levels. And then, frankly, the 30-year bond is going to steepen. We do expect a continued steepening of the yield curve, and there will be more volatility on the long end, especially as investors are monitoring that fiscal development, as we discussed.
Jeff, I have a question on this front. We are talking about the new administration, but what has changed between 2016 and 2024? Is Trump 2.0 different than Trump 1.0? And what do we need to check to see if this time is different, for example?
Yeah, a lot is different about Trump 2.0. First of all, he's more of a known entity because we've seen him as a president for 4 years previously. He's been in our minds for 8 years in the U.S. We're all aware of what he stands for in terms of his headline policies. He's also hitting the ground running by getting a cabinet in place much faster versus 2016. But some of the things that are very different this go around in terms of the environment, the economy, as we've discussed, is running much hotter. It's growing at twice the rate that it was in 2016, and inflation's hotter. So he cannot run the same playbook. We do not think he's going to be able to, he may be able to extend his tax law that he passed in the United States in 2017. We don't think he can go aggressively more than that because it's going to feed inflation and the deficit. Another big difference is U.S. exceptionalism to us is more pronounced. So back in 2016, China was growing 7%. Europe was growing over 2%, and the U.S. was one of the underperformers. That's reversed, and there's several reasons why the U.S. stands out, but he has a stronger hand to play that's going to allow him to go ahead and get some of these things done on tariffs. And Justin Trudeau already came down to Mar-a-Lago to visit him. I think that speaks about the leverage that he has as the U.S. president.
And on this front, do you think that the U.S. exceptionalism will continue to dominate the world economy in terms of growth and the performance that we have been seeing lately?
We do. When we look at some of the advantages the U.S. has, we do not see any reason why that's going to change. 9 of the 10 largest companies in the world by capitalization are United States companies. They dominate the technology space. There's 3 or 4 companies now that have $3 trillion plus market capitalizations. And when we look at things such as productivity, it is twice the rate in the U.S. relative to the rest of the world. So there's a lot of benefit in terms of the ability to grow when your productivity is surging relative to the rest of the world. U.S. exceptionalism is going to remain. The problem is the S&P 500 is trading at 23 times earnings. And so if you want to have that higher growth and the higher innovation, you do have to pay for it as an investor.
Okay, and interesting. I guess we spent some time on the macro policies, potential outcome from the election. Let's dig a little bit deeper. What have you seen as key trend post the election, and what did the market digest so far?
Well, there were several trades that were happening in the week or two before the election that were being called Trump trades that were signaling a higher probability he may win. And going into the election, we were watching this as well. We did think he had an edge. We were not surprised by his win. We were surprised by how quickly and resoundingly he won. But the trades we were watching was the fact that interest rates were going up. In fact, the 10-year Treasury, despite the fact that the Fed was easing, increased 80 basis points. So that was one trend we saw. The outperformance of the financial sector, banks were doing quite well because the thesis would be, and we agree with that thesis, is that the deregulation tone of the Trump administration will be better for the banks. And the third major trend we saw was the fact that small cap stocks rallied massively. You looked at the Russell 2000 on election day and the day after, and there's been a little bit more choppiness since then, but that was expressing a broadening out view that small caps are going to be well positioned with the deregulation. So those trades were quite pronounced. And then, of course, cryptocurrency, which we've all been seeing, and that's been notable as well.
Jeff, if I may interrupt you here, but I will ask two questions, in fact. You were talking about rising interest rate, and you were talking that you have some, I guess what I understood, that you have some expectation that yield curve would be steepening. What are the implications on that front? And on the risk-on mindset that we are seeing in the market, how would that add up, given that credit spreads are so tight in the market at the moment?
Well, the implication is not good in terms of the steepening yield curve.
And that 10-year increase has thrown consumers that are not as savvy on markets. They see the headlines that the Fed is cutting rates, and they wonder why their car loan rate or their mortgage is so much higher. Mortgages in the United States got up to over 7% again. They've come back a little bit. So it's a challenge because the relief that lower consumers need on yields has not translated. The Fed may be cutting rates, but the financing cost and burden that smaller corporations and borrowers feel is hurtful. But the good news is, on your point about spreads, we see strong fundamentals in corporations around the world. Their leverage is quite manageable. Their interest coverage is high, and that's causing the spreads to compress. The investment-grade bonds are near record tights now at 70 basis points, and high-yield bonds are at 260 basis points. So, they are doing quite well, and that helps offset the higher nominal rates of treasuries if you can have that lower spread, and that will benefit corporations.
Please allow me here to take a question from our audience. In fact, since we are talking about trend and what's happening in the market, would the tariffs have a negative impact on equity?
Unfortunately, they will. Yeah, if we have tariffs at the levels that are being contemplated, if we don't, there's no doubt it's going to hurt demand. There will be demand destruction of some kind. It might be modest. It's going to put inflationary pressures. And this is an interesting question. Just like we were talking about Trump 2.0 versus 1.0, when he imposed tariffs in 2017, most of that was passed directly to the consumer. This time, we're not so sure. We actually think corporations may have to absorb some of that in their margins because there's already been a lot of inflation, and global consumers are not in the best position to take on more price increases. So it's going to create challenges. It's a headwind to equities that we're concerned about, and we think when the tariffs start to roll out, it's probably going to be in the summer to the fall that we'll start to see them. It is a risk to equity profits and to equity prices.
You know what? I'll play the devil's advocate, and I will sit next to our audience at the moment. The market has been rallying, and the U.S. equity market is expensive. When we look at the PE, forward PE, it's at 22 at the moment. Forward PE for sure. I'm talking about the forward PE. What is your outlook on U.S. equities, given all the policies that you were describing, given your views on credit spread? What is the outlook for U.S. public equities?
We are neutral broadly on U.S. equities. We are leaning in a bit to
Smaller cap and mid cap stocks because they're not as expensive. So if you take out the top 10 stocks of the S&P 500, you can get that valuation down from 22.7 times to 18 times. Those 10 stocks themselves average a PE of about 30 times. So, those are great companies. We wouldn't suggest that you want to be short those companies. You probably want to be near benchmark weight. But the opportunities to find quality in mid-cap, large cap, some of the S&P 600 names, to us, that broadening out thesis, small caps are trading at a discount of 10 times to the large cap market.
So we think investors will be rewarded by buying cheaper assets, but this is something that's going to take time. It may not work in a given month or quarter. This is something that we think will work in more of a 1, 3, 5-year timeline.
Interesting. And I will add other question from our audience, since we are digging deeper and being granular on what would be the driver of growth in US, and what might be the major theme that you will be focusing on, because you were talking about broadening the set of opportunities into small cap, but would EV be part of that? Would AI be part of that? What are your views?
First of all, we did in our New York office yesterday, we hosted a sustainability conference. This was quite top of mind, and there's a lot of concerns about sustainability as a priority for the Trump administration, but I think there's some good silver linings. So while we do expect it's likely that Trump will pull out of the Paris Agreement on climate and carbon, which is unfortunate, we think that there's the Inflation Reduction Act, which had hundreds of billions of dollars directed towards green energy transitions. And there has been a lot of adoption even among Republicans. They like the job creation. They do agree with the sentiment of trying to be more sustainable in our energy. So EV is going to be complicated. There's going to be headwinds to EV because we're going to see consumer credits probably eliminated. Right now in the US, you can get a $7,500 credit towards an EV, and that's probably going to go away. But it's going to be choppy. There's opportunities, but overall, we think EV is neutral to slightly positive. Now, AI, on the other hand, is quite robust. We think not only in the chips themselves, like NVIDIA and the other makers, but the way that it's being adopted by software, like Microsoft, some of the large mega cap software names are embedding it in their offering. They're going to be able to charge higher fees to their clients as they see the benefit of AI. And then there's going to be certain industries that benefit as AI is deployed. I myself am using it far more. I'd be curious how the audience is experiencing that, but it's the sort of thing that's moving quickly day by day and week by week, and we are quite constructive. It's another reason we think that there will be productivity increases. AI will increase productivity.
Before moving to the global economy, there is an important question. For our audience, it's in fact a common question between the family office and our audience. And at the level of the family office and Petiole Asset Management, as you are aware, Jeb, valuation matters for us. Growth matters for us. We have been talking about the valuation in the public market. What about the valuation in the private equity market or private market in general? And where do you see trend there?
Yeah, that is a key question. And during my intro of the bio that you introduced me on, you were discussing how I also am the co-chair of our public-private committee. And bear with me, I'm pulling up another exhibit just to illustrate this point. But we are highly constructive on private investments. We mentioned the art of the deal, the fact that there will be more deal flow and transactions to provide liquidity, and we think that's going to be constructive for privates. But what I'm showing you here is the enterprise value to EBITDA multiples of the US and Europe and comparing public versus private companies. This was updated, importantly, in June. So there's not been much change in private valuations. You can see the US is at a multiple of about 11. But because the S&P has had such a strong year, the public markets are at an EV/EBITDA multiple in the mid-teens. So you can buy private assets at a hefty discount relative to public. And you also get the benefit of harvesting that illiquidity premium, the ability for private investors that are not having to report quarterly to be able to fix these businesses, generate multiples on your investment. There's a lot of other evolutions happening around GP continuation funds and liquidity mechanisms and secondaries that we can talk about. But there's a lot of opportunity in privates, and we do think it's an area that should be a focus in portfolios.
And on the private side, a few questions regarding investing in real estate. Do you lean toward residential or logistic, or do you find opportunity somewhere else in real estate? And on the yielding front, given that interest rates are dropping, would leasing fund be a source of income as well?
Yeah, we are overweight real estate in our asset allocation committee. We'll review that next week when we get ready for the upcoming quarter, but I think it's likely we'll continue to be overweight real estate. Now that the interest rates have been absorbed
And yes, we talked about steepening and the financing costs are not as low as you would like. They are stable. And that stability is going to allow, there's also been more clearing of transactions. Prices are falling in certain areas like office for sure, but a broadly diversified real estate portfolio could be additive. We also like publicly traded REITs, by the way. So you have an opportunity to be more liquid but the valuations on REITs have come down a significant amount. They're at about 15 times cash flow, which is attracted to us. And I would point out too, when you buy public REITs, you're not only investing in traditional real estate, which makes up about 40% of the portfolio, but you can get exposure into other areas like telecom and data centers and healthcare, warehouses. There's a lot of growing areas to own those assets. On the leasing side, totally agree with you. There's ways to optimize structures, both in debt and equities, public and private, across the spectrum, to really choose the risk profile of what you want and have assets behind your income cash flows. So we do like that area.
And, we have it throughout publics and private portfolios as well as debt and equity.
Interesting. Before moving outside the United States, I just received a question. Would there be any impact on the Inflation Reduction Act and its implication with the new administration?
Yes, there will. It's going to be impacted at the margin. Our view is it's unlikely to be repealed. We don't think there are other aspects of what the Democrats did in 2021 and 2022 that may be repealed, but the Inflation Reduction Act, we think generally is going to be safe, but there may be some targeted revisions to address like the EV credit, as I mentioned. I think that's going to be something that'll be on the cutting room floor.
Jeff, Neuberger Berman, you have 39 offices around the globe. So let's move a little bit to the world economy.
Yes.
What are your views on China in general? We are hearing a lot about the stimulus package. In the market consolidating, are you seeing some signs of stability, or they are still fighting deflation there?
Well, one signal that's being sent strongly about China's future and what it's going through is the level of their interest rates has collapsed. China's 30-year treasury rate just fell below Japan for the first time ever. And Japan has perpetually had low rates. So when we see that symptom, that's a deflationary, recessionary pressure. We know that China has excess housing capacity and a lot of other challenges with their consumer. It's encouraging to see what they've announced thus far. So in September, there was a wave of monetary stimulus measures. And even this week, we had another set of declarations about the rhetoric, understanding the importance of having a looser monetary and addressing fiscally some of these challenges. We think that has taken off the left tail risk, if I could call it that. We think the downside is now more controlled. We're not yet convinced that it's what we would call the fiscal bazooka that's necessary to really help reinvigorate the economy. It's going to be a challenge for China to exceed its 5% growth next year, in our view. But at 9 times earnings, it's basically 1/3 of the S&P or pretty close to it. There is a lot of opportunity if China can stabilize and grow. So we're neutral on China. We're watching it closely, and we would certainly go overweight if we think that they're taking the steps that will finally jumpstart the economy.
Staying in Asia, what about Japan? Japan has been performing well recently on the stock market, despite the volatility on the currency side. What are your views on that front?
Yes, Japan, we are bullish. We did take it down to neutral about 3 months ago because we had concerns about the pressures of the currency, and there's been some political instability. But overall, we think that the corporations, both in terms of those that are more international focused, those that are more domestic focused, strong. Governance has been adopted more. So we did go overweight Japan about 18 months ago and benefited from a lot of that upside movement. The currency is probably the biggest complexity right now. The yen is strengthening again. And you and your investors may remember in August and July, we had that dramatic rally in the yen that caused a lot of carry unwind. That volatility was not good for Japan. Once the currency gets situated, they're trying to tackle inflation. Our view is, which is a bit of consensus, is we think the BOJ is going to raise rates imminently and probably take their target rate up to 75 basis points. Once we get through that hiking cycle, we think it's full speed ahead for Japan, and we'll probably take it to an overweight.
And what about the old continent? I understand that the French are facing an issue with their budget and their government at the moment. The German, they are waiting for a new election early next year. But maybe the UK, they are seeing some stability on the government front. And post the announcement of the budget, we didn't see a big climb in the long-term yield. What are your views on the United Kingdom?
The United Kingdom, you're right. I think of those three countries you just named, they're better positions. They also have some stubborn inflation that they're trying to tackle. And I wouldn't say that their political situation is the epitome of positivity, but it's more positive than what's happening in France and Germany at the moment. And I think that's going to allow the UK to settle in. And we think that they're going to be on track to generate GDP in excess of 1% and be fine. We have a lot of concerns about the trend in France in particular. The political disruption that they're feeling has resulted in their interest rates increasing well above the Bund. I think it's about 90 basis points, which is getting near record levels. And that is a testament to the fact that they're dealing with these challenges on the size of their deficit. There's going to be more volatility around that. It was encouraging that Le Pen indicated, because she is such a key player in this entire dialogue, but the importance of having a rational fiscal approach helped alleviate some of those pressures. But overall, the French equity market has been quite challenging. We are neutral because it's so cheap. We don't want to be short something that's so cheap. But we do have so many concerns about the way that the political situation will unfold in the near term.
Good. Jeff, we at the family office, we are inclined to develop market when it comes to private equity or private market investing in general, because we believe we have high governance, we have deep capital market there, proper due diligence. But I have a question from the audience. I would like to take it. They are asking about your views on private equity investment in emerging market. Nina, maybe, I'm not sure if it's part of your scope, but what are your views in general on EM?
Well, EM in general, there's opportunities, and more so on the public side. I would make a comment about India, which I think has a lot of good things going for it. So Modi's administration and government has been quite stable. They have an expanding manufacturing base, strong economic growth, and investor flows are positive. I think it's over the last 18 months, there's been 20 billion of foreign capital that's come into India. The challenge with India was it got expensive. So in some cases, even more expensive than the U.S. equity market. There was a correction, though, of about 10% over the last couple of months. So there might be an opportunity to focus on it. We like India. We even meet with a lot of the members of the government there. And the tone is positive. They understand a lot of things. They're also, in my view, not in the crosshairs of the Trump administration tariff dialogue. So I don't know if we would necessarily go into the privates on that side, because I think there's a lot of complexities about market access. But publics, we're interested. We may upgrade India in the near term. On EM as a whole, I think it's important to be a global private investor. China, in our view, would not be an area to prioritize, just given these challenges and the uncertainty around the way that the Xi administration is going to respond to a lot of even these tariffs and the trade wars themselves. But when we look at other countries like Vietnam, frankly, Latin America has some pockets of interesting countries and sectors. We would be diversified globally in terms of the private investment program that investors put together.
Great. Two questions that might be related. What are your views on global central banks' action into next year, and your views on foreign currency vis-a-vis the US dollar? Are you bullish the US dollar, neutral, or or bearish maybe?
Well, we're bearish in terms of the valuation of the dollar. On a purchasing power parity basis, we find it expensive, but we don't expect the drivers of the dollar to change anytime soon, because of the fact that our economic growth is so much higher and our yields are so much higher. So it's going to be an attractive carry currency. We have the advantages of U.S. exceptionalism and our longstanding power of being a reserve currency that's working in its favor. So while we think the dollar is overvalued, we're not short the dollar. I think that could be a really tricky bet to make. To
answer your question about around the world, I'll just share another exhibit here on the right to show you the 4 major central banks of developed markets around the world and where we sit and what our expectations are. So the Fed, I mentioned, we don't expect a lot of cuts. It's going to be more hit or miss in the next year. And the terminal rate, we're probably closer to 375, honestly, than 350. But the ECB, we think, needs to be cutting more aggressively in light of the challenges that we talked about in France and Germany and other countries. So right now, we think they should be cutting at the rate of 50 basis points per cycle and get that rate down to 2% as soon as possible, and that they're progressing too slow. And the BOE, we think they can cut rates to about 3%. BOJ, as I said, we're a bit more hawkish on BOJ relative to the market. We think they're going to have to hike rates a little bit more to get their inflation under control.
I would like to touch upon a point that you explained earlier in your answers. You were talking about deal recovery. In fact, part of this global trend, and some of the audience, they are asking this question, we are seeing IPO recovery in the MENA region, for example. What are your views on IPO recovery in general, globally, not only in the MENA region, especially that these IPOs were oversubscribed in general?
Well, that's really
their impact on private market, in fact, and their impact on private market. That's very important at the moment.
Yeah, very encouraging to hear that that's what's happening in MENA, and I hope that the U.S. will follow that behavior, because right now it's been a drought of IPOs. Maybe a little bit of uptick in 2024, but 2023 was a major drop. Just to give you some statistics on what that meant for exits as a whole in private equity landscape. In 2021, we had a peak of exits of about almost $2 trillion, and that held to 700 million as the run rate. So that's why we have this entire problem of the lack of DPI, distributions of paid, investments. But we do expect with the Trump administration, and we continue to talk to the banks, what they're hearing about in terms of interest of IPOs. We do expect a meaningful increase in 2025 for IPOs. We don't necessarily expect that it's going to revert back to that 2021, which was a red hot rate where we had a lot of things going on. But right now, IPOs are only about 5% of exits for privates. We think that could grow to 20% next year. And it's a very, we're hopeful. We need some liquidity in the private investment ecosystem.
Interesting. And given the valuation in the private market that you showed us earlier, do you think that secondaries are still an investment theme that we can still play?
We do. And I think you can play that in multiple avenues. So until those IPOs come and the fact that investors want liquidity, you have LPs that are in a position where they want to get cashed out, that the fund life might be getting longer. We're seeing holding periods up to 6 years in some cases on average, which is well above the historical. And so with that, if you are opportunistic and you provide liquidity, we think you're getting a discount on those assets that you buy. So traditional secondaries are still a great way to do it, where you're buying the interest from the LPs. But we also do like continuation funds that are led by the GP. You get great transparency on the assets that you're acquiring. They're typically high quality assets in their portfolio. And by buying them, you're getting real-time cash flows pretty much day one. It mitigates your J curve because these are businesses that have already been acquired and are being executed. And hopefully it'll allow you to exit at a better valuation.
Interesting. And what about a strategy that would follow a take private in the market at the moment, especially on the private equity side? And what about focusing, for example, on preferred equity as a strategy in the capital structure when it comes to private market?
Yeah, we like both of those tools being in the toolkit. And when we construct private equity funds and separate accounts for our clients, we want to be diversified. We're optimistic. We lean into certain areas. On the take private, I'd say just because the public markets are so expensive in our view, maybe not as active there, although there can be situations where that makes sense if a public valuation has been adversely affected, where you're getting something cheap that you can take it private. Capital solutions, for your point on preferreds, absolutely. This gets back to our idea of being a provider of liquidity, where you can have high quality assets
and the GP needs to be perhaps doing a bolt-on acquisition, or they need to do something for the business, the ability to earn high returns by being a preferred holder and then getting equity optionality on to the upside, but being more senior in their capital structure, we think is a great way to generate additional returns.
Jeff, I want to benefit from your presence with us here in our webinar hosted by the Family Office and Petiole Asset Management. I will push you to your limit now. As a Co-CIO, let's forget about the investment committee. What is your contrarian view? What are you going to tell our audience and our investors?
Well, I think that the enthusiasm that we understandably feel as we have what could be the best year for the S&P 500 in a century, we might exceed what we saw in 1998, and you'd have to go back to the 1920s to see a near 30% gain. The fact we have the Fed easing, yet we have profits growing 10 to 20%. We have a lot of momentum. We have tight credit spreads. We are in a major risk-on market. Unfortunately, I think the valuations have gotten to a problematic level. The volatility is going to get harder. And as the enthusiasm begins to wear off in the early part of next year, to be contrarian, I think that it is sensible to be cautious in terms of what you expect from your equity portfolio, particularly U.S. mega cap equities. So I don't want to be, it's a very rainy day here in New York. Maybe that's causing me to feel a little sad and grumpy on that. But unfortunately, I just don't think these good times can continue in the same run rate. And there's going to be hard challenges around cutting spending for governments. There's a lot of tough problems ahead. So while it feels very good right now, I don't think we should get too used to that being like.
Interesting. And we have been talking about opportunities, trends. To wrap up, what would be the major risk that we need to pay attention to in 2025, in your opinion? There might be more than one risk. Always aim is to protect the downside and to preserve wealth for our client.
Yeah, let me say that what keeps me up at night is it's those unknown unknowns. I think that's a term you and I have used in the past when we've talked before, right? Where Korea happens. And thank goodness that the institutions did their job, and the actions that the president irresponsibly took were overridden by the assembly. But we had Romania, where that was supposed to be a free and democratic election. I understand the candidate is not ideal from a profile of his views, but they may throw out a fair election because of the allegation of Russian interference. We talked about France, Germany. There's so many countries. The U.S., at least we've settled our election for 2 years. I worry about this political instability and the geopolitics that come with it. I mean, the China-Taiwan threat looms out there. We were very happy to see the developments in Syria in terms of getting a horrible leader out of that country, and it's going to impair the ability of Russia and Iran. But they're going to continue to push buttons on the geopolitical landscape. So these things are what keep me up at night, these unknowns that you have around geopolitics.
Jeff, please allow me on behalf of the Family Office and Petiole Asset Management and our audience to thank you a lot for spending your morning directly from New York with us, for your insight and valuable information. Just to remind everyone, you were touching upon the key investment themes into 2025, and you believe that the next year is going to see some above-trend growth in certain sectors, especially that we might see some balancing between pro-inflationary forces and pro-growth forces. You explained very well what is the mindset or the framework that we need to look at when we think of the new administration and its potential policies. Your key message was to diversify and to broaden the set of opportunities, be it in the public market, not to look at one sector or one style. Maybe the small cap is a style to look at carefully through a managers. That's very important. And on the private market side, you pointed clearly that the valuations are attractive. Secondaries are still a play. You have an overweight on real estate in general. You had a view on the United Kingdom, and you are telling us to pay attention to the downside risk, and it seems that geopolitics may create some volatility down the line. please allow me to thank you and to value our partnership. It has been really an insightful session, and hopefully we'll have many more to come. I would like to thank our audience, our investors, and the support that we are having from our team here at the family office. Thank you very much, Jeff, for your presence.
Thank you.